Hey everyone, Nick Diobertis here, teaching you financial modeling. Today, we're going to be doing an introduction to the market value of debt, how to think about it, and how to calculate it. And this is part of our lecture segment on the discounted cash flow valuation model, focusing on the cost of capital portion of the model. So, we already talked about the cost of debt in prior video, and now we are getting into the market value of debt because we need the costs and market values of each of equity and debt to ultimately be able to calculate the weighted average cost of capital, or WACC. So after a bond is issued, its value can change over time, and it almost certainly will change over time. And this is not a debt course, and so I'm not going to go into a ton of detail here. So definitely reference some additional debt materials if you haven't learned about any of these concepts before. When we think about the value of debt, be it bond, bank loan, whatever else, we can determine its value just like any other financial asset. Any asset that pays cash flows, we can always just take the present value of those future cash flows, and that will get us the value of the asset. So for a bond, it's going to be the regular interest or coupon payments, and then the final principal plus coupon payment in the last period that we use to determine the value of the bond. But remember that when we take the present value of something, it's both the cash flows as well as the discount rate that affect the value. And with bonds, the payments, the interest coupon payments, are contracted at beginning of the life of the asset and remain in place for the entire life of the asset. A bond is just a contract which says that the company is going to pay a certain amount of interest in return for a loan, and then they're going to return the money at the end. And so the value of the bonds can change over time, but the interest payments cannot change. And so that means that what must be changing is the discount rate, because those are the only two components of the present value equation. So why would the discount rate change for a company? Well, a discount rate for a company is supposed to be reflecting the amount of risk in that company. And specifically, we're looking at the rate on the debt, so specifically the riskiness of the company's debt. So a lot of things can affect that, and for most companies, it does fluctuate quite a bit over time. Some things that could affect that include taking on additional debt. If you have a lot of debt already in your capital structure, you've got to be making all these interest payments. It becomes more risky to issue additional debt and have an even higher interest payment. Could be starting a new project. If this project, especially if it's something new that the company is trying to innovate that is not comparable to their existing operations, it could be substantially more risky or less risky than the existing operations, and that's going to change the overall mix of risk in the company and therefore the cost of debt. Or even just having a bad year can change the cost of debt or discount rate for the company because they have to make those payments on their interest, and that's what debt investors are concerned about. If all of a sudden they're less profitable this year and they're only barely able to make that interest payment, that's a very negative signal for going forward in their ability to pay the future interest payments. And so that raises the discount rate. So, why should we care about all of this? Let's walk through an example. So a company issues a bond. It's a 3-year bond, 10% coupon. And as is typical for essentially every bond, the bond is going to be issued at par. And that means that the principal, the value of the principal is uh, equal to the price at which the bond is being issued. Um, Companies always just set it up this way. That's kind of the standard in the industry, is to do this so that the price of the bond when it's issued is 1,000, the same as the face value, par value, principal value, $1,000. And when we have a stream of cash flows like this, 10% per year, and then getting the interest plus the principal back at the end, then the discount rate must also be equal to the interest rate in order for the bond to be priced at par. So when it's issued, everything is in sync. The coupon rate is equal to the discount rate, and the price of the bond is equal to the face value of the bond. So a year passes by, and now the company becomes substantially more risky. They had a bad financial year, or maybe one of the other situations we talked about. They issued additional debt, etc. But now, in order to issue new bonds, investors are requiring that the company offer 15% in order for people to be interested in buying these bonds. So because of that, now we see that the existing bond that they had outstanding, the 3-year, which was originally priced at 1,000, is now priced at 918.71. And that's reflecting that if someone buys a new bond that the company issues, they would earn a 15% rate of interest. But if they buy this existing bond, they would only earn a 10% rate of interest, less than the rate which would now be offered by the company. And so they should not be willing to pay as much for that when a new bond would cost $1,000. And we calculate the IRR on that bond, which is the yield to maturity, and that would be 15%. So the 15% yield that we have on this existing bond with its new market price matches up with the cost of debt for the company, what it would cost to issue a new bond. But if we look at the book value of the debt, the book value would still be at 1,000. The book value just stays at whatever it was issued at. And so if you were to try to calculate the yield to maturity or cost of debt based on that, thinking about it as being priced at 1,000, then you would get 10%, which is far away from the actual new cost of debt for the company. You would also say that debt has a greater proportion in this capital structure than is actually the case because it has actually decreased in value. So we can end up with quite inaccurate estimates if we focus completely on the historical rather than looking at the market. So how do you go about calculating this market value of debt? So we'll discuss 3 different approaches here, and similarly to the cost of debt, it's going to depend on what data you have available, which approach that you can use, and some are going to be more accurate than others. So first approach we're discussing here is the pure financial statement approach. And for that, you're just taking the book value of debt and using that as the market value of debt. And sometimes that's all you have enough data to do, and so you just kind of have to settle with that. But it's always preferable to be able to look at what's going on in the market currently to be able to come up with the market value of debt rather than just looking at the historical because of the issues that we just talked through. So then, if you have the cost of debt, and it's actually a market cost of debt from the market bond approach, and if you know on average the maturity of the company's debt, then you can basically model all of the company's debt as one big hypothetical bond and use that kind of valuation approach to come up with the market value of debt. And that's going to be more accurate than the financial statement approach because it does consider what's going on in the market currently. But there are a number of assumptions we have to make here, and so it's not as accurate as the last possible approach, which is you have information on all of the debt that the company has and the current details of all of those. You can calculate the market value of each individual debt instrument and sum them up to get the total market value of debt. So this is going to be the most accurate, assuming that you can collect all of the data on this. If you are missing substantial portions of the instruments, or if you can't get it at all, then it's not going to be an accurate or feasible approach. But if you have that information, it's going to be the most accurate. So those are the three approaches we're discussing in this course, and we're going to look at how to implement each of them in the following video. But before we wrap up, I do want to just talk a little bit about the seniority of debt. And we're not going to handle it within the examples in this class, but it is something that you want to think about if you go to build a more serious debt side of a DCF model for when you need to be really accurate in the model. So seniority is the concept that when the company goes bankrupt, or if the company goes bankrupt and they're liquidating the assets, there is an order in which the different debt holders get paid off during this process. So debt holders get paid before equity holders, essentially always. You pay off all the debt holders, and then if there's anything left, it will go to the stockholders. But oftentimes, there's not even enough money after liquidating the assets to pay all of the debt holders. And so some debt holders are going to get paid and others are not. And the seniority is what determines that. So seniority is just about this payoff order. A senior loan is going to get paid off first. And then if there's still money left over, then the junior loans are going to get paid off. And there are different levels of seniority. It's often just referred to as just senior or junior, but a company can have as many different levels of seniority as they want. It's just however they write the bond contracts. So the seniority is important because lenders have to consider this bankruptcy recovery scenario when they are setting the rates that they would be willing to lend at. And if you have a senior loan, then in this recovery process, there's a higher chance that you're going to get more money out of the process. And with a junior loan, there's a lower chance that you're going to get money, or how much, or you might not even get paid at all. So the junior loans have to command a higher interest rate in order to compensate for the fact that they're not going to get paid at all or as much in the recovery bankruptcy process. And when thinking about the cost and market value of debt in this class. We're not working with the seniority. We're just assuming everything has the same seniority. But in a more detailed model, you would want to find the different levels of seniority in this specific company's debt structure and treat them separately. So here, say there's 3 levels, a senior, a junior, and kind of a medium level of seniority. Then you would just take these as 3 categories and you would find the costs of debt within each of these categories and keep them separate in the analysis. So it's not going to be a big change beyond what we're doing in this class, but it does complicate matters a little bit. And so that's why we're not handling that here, but it will be easy to extend into that after you understand the basic process. So that's how we can think about calculating the market value of debt. And we'll come back in the following video to look at examples of calculating this. So thanks for listening and see you next time.